Alright, what's good everyone? Welcome to the lesson on managing risk in a trade. This one is being recorded on Saturday, October 25th, 2025. In order to properly understand this lesson, you should have gone through all of the other Wobbit lessons as well as my model. Even though my model comes after this specific video, you should still go forward and watch that before moving on, just to properly understand what you're getting into. And additionally, the big aspect as to why this lesson had taken a while to be released is simply due to the fact that I was contemplating even making one, because when it comes to managing risk in a trade, when to go break even, when to partial, where to target, those are all taught in the trade reviews. And the reason for this is because the logic reasoning behind all those is going to change with every single trade, because even though all my trades relatively look the exact same, structure, narrative, all those are different. They differ for every single trade. Even though they look the same, they differ every single time. And there's no exact same scenario where structure is the exact same. So all I can do in this video is just simply give a blueprint slash rough introduction slash guide. And you're going to learn more in depth through watching my trade reviews, but for now this is going to be just an introduction video. The first thing we're going to do is just understand realistic expectations. Obviously we know that we set realistic expectations going into a month, going into a week, going into a day, but what about going into a trade? So the first aspect of this is understanding when you're in line with order flow or not. So when you're in line with structure, whether we're bullish or bearish. If we're bullish and you're fading that, you're going for shorts, then you have to understand where price is drawing to and why. And when I say that, I'm essentially telling you that you should not be expecting a full reversal. As we know, and as I teach, is that we do a top-down analysis of all our higher time frame power threes to understand what stage of them that we're within, whether we are distributing, manipulating, and so on and so on. So if our yearly, quarterly, monthly, weekly, and daily power threes are all distributing higher and you're taking a short within your 30-minute or 4-hour power three, you have to understand what we're drawing to. So let's just say that within our daily power three, we lack sequential SMT at low of the day. That and only that is going to be a valid target as a draw on liquidity. Nothing externally. You're not expecting an external draw on liquidity if your weekly power three is distributing higher. No. It's either going to be a higher time frame or mitigated imbalance, potentially a range EQ that needs to be rebalanced, and so on and so forth. So it's as simple as that. When you're fading the higher time frame, you have to know what a realistic draw on liquidity is. When you're fading it, do not target external draws on liquidities. And then of course the opposite is going to apply when you're in line with higher time frame. So if the yearly, quarterly, monthly, weekly, and daily power threes all distributing higher, everything checks off, then and only then are you valid to target external draws on liquidities. And the first reference is going to be a trade such as this. I had taken August 22nd, and this is the overall setup for that day. 1 hour buy model. Going into this day, while it looks, obviously, this, when you see bear structure like this, that's not bear structure. Obviously, if you're watching this, you learned from me, you know what this is. You know price was delivering from the monthly fractal. You know our higher time frame power threes, our yearly, quarterly, monthly were all distributing higher. And we were just looking to play continuation of that. This retracement had ended with the monthly fractal. We had weekly cycle, I think also monthly cycle, sequential SMT, all those checking off, daily cycle, and so on and so on. Going into this trade, everything checked off for higher prices for the reversal. So if we know that our yearly, quarterly, monthly power threes all distributing higher within our weekly power three, as of now was bearish, but we're expecting a reversal at the end of the week, we can then target external draws on liquidities. So my specific target for this day was the previous day high. On a higher time frame, that's an internal draw on liquidity, not an external. But on a lower time frame, that is a, oops, let's go, went a little bit too far. Go back here. So a trade like that, we had the external draw on liquidity, which was the previous day high. In fact, I targeted something beyond this, but my point is, going into a trade like this, we've taken a long position off of a, well, I already recapped on this day specifically, but when it comes down to whether to target this high, my bad, this high, or the external draw liquidity, it's going to differ trade to trade. Obviously, I'm not going to go back and give an entire daily review for the trade specifically, but we understood that we were playing the higher time frame reversal. So by doing so, we then set realistic expectations. So when you go into a trade, you're only going to target, a time-based high or low. And here we have only two time-based highs and lows. You have your previous 9-minute high, which is actually down here, and your previous day high. Those are the only two possible draws on liquidity that you could have. And when you go into this trade, set realistic expectations. My entry was generally down there. Stop loss at the low, TP at the high. When you look to partial trim, you have to understand your risk to reward. And when it comes to a risk to reward, you have to understand what is more logical to go break even versus trim partial at. And here, when you look at a partial, as we know with my specific model, we really don't look at anything under a 1 to 3 risk to reward. Occasionally a 1 to 2, 1 to 2.5 can be valid depending on what we're given, but in a given like this, we're expecting a higher time frame reversal. We're expecting a high risk reward model. So here, the realistic thing you can do is go break even at this high, which is your previous 9-minute high, which gives you a one just under 1 to 2. And that's realistic because we don't want to partial for anything under 1 to 3, and we don't want to just sell early. So the best thing to do is just go break even at that time-based high and still target the external draw on liquidity. Now I had in fact partialed at the new log for this day. I don't remember exactly where that was, but right here. So just over 1 to 3 was my partial, and then my ultimate TP was a 1 to 5. And I unfortunately had improperly managed my risk, which is something we're going to cover right now. Improperly managing your risk. Now this is going to be up to your own data collection, but specifically for my model, I am never supposed to trail further than my entry. And what I mean by that is I'm never supposed to trail my stop loss in profit. And unfortunately on this day specifically, I had done that. I had trailed it in profit and I've been wicked out, and then we took off higher. And since then, I stopped doing that altogether, and I completely just leave it to go break even. Because when it comes to our entries specifically, with how precise they are, they tend to be the higher low of the day. And if we are truly catching the higher low of the day, we know those are protected highs and lows, and those should not be returned to. And by doing so, we can allow ourselves to keep our stop loss at break even compared to in profit, because at the time of our entry to the time of our TP, market can do whatever it wants. Market can do something exactly like this, retrace all the way down here and then take off. We have to keep stuff like that in mind. So when it comes to managing the trade, we strictly keep it at break even and so on. Now, when we get more specific in terms of a predefined plan, which is something I talk about always, this comes down to 4 things. When it comes to a predefined plan, you make it very simple for yourself. You have your entry, you have your stop loss, your take profit, so when to TP, your full TP, and when to partial, and then when to go break even. Nothing outside of this matters, and every single time you go into a trade, you have to know this. Now, specifically where I'm at, I don't need to do this. I don't, in terms of write it out, but you guys definitely should be writing it out. So whether that's on Notion, just on Discord, you should be writing out the logic behind your entry, the logic behind your stop loss, the logic behind your take profit, and the logic behind going break even. A trade like this, the logic behind my entry, well, I'm not going to go over that for this specific trade, but I had it. The logic behind my stop loss was the fact that we had microcycle attached to it. We had 1 minute swing divergence, 1 minute PRC swing divergence, microcycle. We might have even had 90-minute sequential as well. So that is a protected low. When I go break even at, well, we had the previous 9-minute high, which is our only time-based high below the previous day high. So that's the most realistic thing that you can do. And then when the TP at, well, that is going to be your previous day high. But there's always a possibility that we reverse before then. So we always want to look to partial at least once before ultimate TP, especially if our TP is going to be over 50 points. So my partial was realistic. It was the first new one, I think, new dog above our entry, and it was 90 points away. So it was a pretty realistic TP or partial, which offered over 1 of 3 risk reward. And it's stuff like that, setting stuff like that up beforehand. So when you go into a trade, write it out, write out the entry confirmation, or write out the logic behind your stop loss, logic behind the take profit, TP and partial, and then of course the logic behind break even. Nothing else aside from that matters. So when it comes to going break even, it's simply just a safety button, and don't believe anyone who says you do not need to go break even. You do not need to go break even. That's not the case. When it comes to our model, if we truly, again, if you're truly following my model, you're in line with higher time frame narrative, you have a clear action on liquidity higher, you have higher time frame, a lower time frame sequential, and a lower time frame CISD. If it's all correct, then you should be fine. However, there are times when we run out a time-based high or low that we could retrace short-term reverse to whether rebalance, whatever it might be, run out some sort of sell stop before continuing the higher time frame. It does not matter. We have to manage our risk because specifically from our model, it often saves us. But again, it has to be planned, not emotional. That's essentially the topic of what we're saying here. When it comes to going break even, we always go break even at a realistic time-based high or low. Or potentially, if we have a unbalanced range below, we're trading the reversal, we can go break even at EQ the range. Because if we're truly catching the reversal, there should be no reaction at EQ. Aside from that, when it comes to going break even, it has to be a plan that you define beforehand. Again, going in line with predefined plans. It has to be planned out, not emotional. Before you enter, you need to know exactly where you're going to partial at, exactly when to TP at, and specifically where you're going to go break even at. It has to be decided beforehand. If you do not know, then do not enter the trade. So before you enter, you should already know where price must reach to justify moving your stop loss. You can only go break even at levels where price has a real chance to reverse significant highs, significant lows, EQs, assuming that EQ is backed by sequential SMT. And that's what I was talking about earlier with potentially reversing at EQ. We're only going to reverse at EQ if there is, it only poses the possibility that we're going to reverse at EQ if there's sequential SMT supporting that structure. If there is not, then do not expect us to continue. And then once that level gets hit, you've already taken the logical draw. Structure justifies protection. Protect your stop loss. It's not fear. It's not being scared. It is being logical. But if you're going to break even just because you're up a little and don't want to lose, that is fear. That's what fear is, and that is not discipline. And you're killing your trades that were never in danger. So again, predefined plan, when to go break even. And yeah, there are times where you can adjust your predefined plan. When it comes to adjusting your predefined plan, these don't happen too often, but there's always a chance. The first aspect is reversals. So if you're playing the reversal, you're fading the higher time frame momentum. So you understand that you're fading the yearly power 3, the quarterly power 3, the monthly power 3, and the weekly power 3, and so on and so on. If you understand that, and maybe you're shorting all the way down to EQ, potentially trying to anticipate a full reversal, this is where this applies. So when you're fading the momentum, that means risk has to be tight, and every single confirmation matters. And you have to take partials, TPs, a lot faster. When it comes to reversal, your job isn't to predict the higher time frame reversal, it's to understand where price needs to go in order to continue the higher time frame. So what we're saying here is that if you know you're fading the higher time frame order flow, you can obviously, trade it in anticipation that we're going to full on reverse. But if, let's just say that you are taking a long position back here. Let's just say you're taking okay, my bad. Let's just say you're taking a short position, whatever it might be. Maybe there's a 15-second CISD right there. You want to try to anticipate a full reversal for whatever reason, but you have to set a realistic plan. So like something like right here. You're fading the higher time frame order flow. Price retraces into discount. In discount, right here, what do we do? 1 minute time frame right here. Goes into discount. I can't go down to the 15-second. Anyways, what I was trying to show here is that we are traced into a 50-minute fractal, which I guess I'll just show. 50-minute high, 50-minute low. We are traced into a 50-minute fractal in discount. We already know the higher time frame is bullish. We're traced into a discounted 50-minute fractal. From there, we then formed a 15-second CISD, also while delivering from a 1-minute SMTF. Almost hard to see, but it's there. Discount, 50-minute fractal, 1-minute SMTF, 15-second CISD. That would be your confirmation to sell early, mitigate the risk, and then try to maybe catch the higher time frame, maybe try to catch longs. It's situations like that. So like initially you're anticipating price to drop all the way to low for whatever reason. Obviously this is just an example, but if price does something like this, you know, you reach discount of this unbalanced range and so on, form a valid setup for longs, then you can validate selling early. Okay. Now the other thing is continuation. If you're trading continuation, then bias is in your favor. You can allow to give your trade space. And when it comes to trading in line with the higher time frame, invalidation of the higher time frame only really comes when either higher time frame structure shifts or power threes expire. So if you are maybe trading the, let's just say hypothetically, well, not actually, none of you guys are really swing trading. Okay, let's just say you're trading the 4-hour power 3. You know, you're trading the 10 a.m. 4 power 3. Maybe you're in a long position, maybe like 250 points away. You're targeting the previous week high, hypothetically. When you are long, you know, within that 10 a.m. 4 power 3, and let's just say you've been in that long for a few hours. 2 p.m. opens, we form, let's just say noon hits. Noon hits, and then we come up, we form daily cycle, we form 90-minute, we form microcycle. We form 3-stage sequential at the highs, and then all of a sudden 15-minute, 5-minute, and 1-minute structure all flip bearish. That is a potential scenario where you can short-term sell and then potentially look to re-enter if we form another valid long setup. So we're just going to show this on a singular chart. Hypothetically, we do something like this, where, again, imagine, we'll just draw it out. So boom, 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 boom. Yeah, let's just say that, and that is your previous week high. So that's your previous week high. That's your John liquidity. We form daily cycle. I don't know what that was. Daily cycle, 90-minute slash micro, targeting the previous week high. Something like this. In a situation like this, and let's just say long down here. So that's the short position. Let's just say long, like off of 1-minute CISD down there. Something like this. And let's just imagine you're up like 150 points, 200 points. Price shift structure on daily cycle. We have daily cycle, 90-minute micro, 50-minute, 5-minute, 1-minute structure, all flip bearish. In a scenario like this, you can definitely mitigate your risk, especially if we're coming closer to the end of the day. Because if the daily power 3 ends, the fuel ends, we're unlikely to continue drawing towards the previous week high, especially if we're still early on in the week. And the reason for this is because market's going to do what the market's going to do. Forming sequential SMT is a potential sign of a retracement or of a reversal, and there's nothing wrong with mitigating risk, especially when you're in a ton of profit. Because let's just imagine that this was the pre-say high. Like, you're already trading above the pre-say high, above every other time-based high. And the only other external drawn liquidity for the day was a previous week high, and you're just drawn towards that. It's perfectly logical to sell early in a scenario like this. There's no shame. You can do that, especially if you're up a ton of points. Don't be so arrogant that you think that price has to reach where you think price is drawing to. No, lock in profit, especially if you're up a ton. And then the last one is consolidation, and this one's a tricky one, and mainly is going to be learned from experience. But let's just say that you enter I'm going to try to find an example while I talk, but let's just say that you enter position, you're trading the 930 30-minute power 3, market opens, it initially looks super volatile, like it's going to potentially be an amazing day. However, 9:30 opens, you enter maybe like 9:35-ish, give or take, doesn't really matter. And then all of a sudden price just begins to accumulate. Even though you might have a clear extra draw on liquidity, high or lower, whatever you're targeting, whatever you're in, and we accumulate. We accumulate from 9:30 all the way up until 11:30. 11:30, 10:30, whatever it might be. If we just been strictly accumulating, essentially just going between 10 points in profit, 10 points in drawdown, not really going anywhere, that's a scenario where it's best to sell before the next significant time opening, because chances are following that significant time opening, we're going to get manipulation, we're going to stop you out before we continue in that direction of whatever direction you're drawn towards. And there's really no shame in this, but it needs to be logical. It shouldn't just be because we consolidate for 15 minutes. No, it should be hours on end. So if we consolidate for an hour, hour and a half, 2 hours, or even more, that's a valid excuse as to why you could or should sell early. Again, there's no shame in that. Just sell early and then say to yourself that you are willing to re-enter the position if a new setup occurs. Because again, if price truly is accumulating right at your entry for like 2 hours on end, let's just say right before noon, you enter the trade at like 10 a.m., we consolidate up until noon. Okay, sell early, sell a break even, and wait to see what price does, because potentially market then at noon could manipulate, stop what would have been your stop loss, and then form new daily cycle, 90-minute, and potentially micro. Then boom, you have all of a sudden a new setup that you can take, and it's a lot more high probability because we had already left that accumulation and manipulated. So now logically you're now then playing the distribution. Next, we're in a partial, and this is very similar to winter break even that, but more or less if you're up a significant amount of points. So like let's just say 50 points or more. That's usually the thing for me. If I'm up 50 or more points, I'm looking at a time-based higher low to potentially partial at. So partials should not be random. They are taken when probability is 50-50. So when price has a 50-50 chance to reverse, and there's always, even if you're trading in line with the higher time frame narrative, higher time frame order flow, structure, you have clear extra drawn liquidity, there's always a 50-50 chance that price could potentially run out at time-based higher low, form sequential SMT, and then retrace, stop you out, and then continue the higher time frame. There's always a possibility, and that's why we partial, because even though we know we have a very high conviction with our trades, there's still always a possibility that we are wrong or even that we're right, but the market has one more stage of manipulation before continuing. So that is why if we're in a position, we always look to partial at some sort of time-based high or low. So usually for me, that's going to be 50 points or more. And that's because most of my TPs are an average of like 80 points to 100 to 150 and so on and so on. So if we see over 50 points, we run out the pre-segment high for 9 sequential, boom, that's a valid reason to trim. But yeah, it's essentially just understanding that you have to set realistic expectations, because that is how you lock in profit consistently. Again, a lot of people just get too much excitement with holding the entire position up until the drawn liquidity, often because they're greedy. They're just greedy. They want to hold 3 minis over 100 points, even though they could really, really use, that $1,000 if they were just trim for 50 points. The time is higher low, they could use that. And again, you just have to set realistic expectations. You have to respect the market. Understand that's not just going to continue moving in your direction just because you want it to. The market's going to do what the market wants to do, and that's it. Again, we are not trying to control the market. We're not trying to predict every single move the market makes. All we're doing is just catching our piece consistently, and that's really all there is to it. But again, when it comes to my trades, every single one has different logic as to why I break even, why I partial, why I hold my TP until where I do. All it is just understanding what structure gives us, what we're presented with, and so on and so on. That's it. Don't overcomplicate it. It's simple. You just need experience. You just need to track your wins, track your losses, and all you have to do is just continue to do that. Again, I wish I could have gone in a little bit more depth in this video. Truthfully, all I could do is just give you guys an introduction, a proper mindset to have going into your trades. But at the end of the day, all you can do is just learn from my trades in my trade review channel and apply that same logic yourself so that you can make up your own logic. And until then, I'll catch you guys all in the next video.